Pension funds are among the largest institutional investors in the world. The top 10 pension funds globally manage more than $6 trillion in assets, and yet very few finance professionals, even those working in asset management, fully understand how they actually invest. In this video, I am going to explain how pension funds build and manage their investment portfolios. What drives their decisions, what they buy, and what constraints shape every allocation they make. Let's start with the fundamental question: why do pension funds exist? A pension fund exists to pay retirement benefits to its members. A company, a government, or a public institution collects contributions from employees and employers over decades. The fund invests those contributions, and when members retire, the fund uses the investment returns and the original contributions to pay their pensions. That sounds simple, but the investment challenge is enormous. Pension funds have obligations that extend 30, 40, or even 50 years into the future. They need to be able to pay benefits to members who are retiring today, and to members who will not retire for another 30 years. And they need to do this regardless of what happens in financial markets, what interest rates do, or how long their members live. This is not retail investing. This is liability-driven investing at an industrial scale. So, how do pension funds structure their portfolios to meet these obligations? Everything starts with the liabilities. Before making a single investment decision, a pension fund models its liability profile in detail. How much will it need to pay, and when? Which benefits are fixed, and which are inflation-linked? What is the average age of the membership, and how long are members expected to live? This liability profile, its duration, its cash flow schedule, its sensitivity to interest rates and inflation, is the starting point for every investment decision. The portfolio is then built in two distinct parts. The first part is the liability matching portfolio. This is typically the largest part of this portfolio, often 60 to 80% of total assets. It is designed to mirror the interest rate and inflation sensitivity of the liabilities. Long-dated government bonds and inflation-linked bonds form the core. Interest rate swaps and inflation swaps are used to fine-tune the duration and inflation exposure. The goal is simple: when interest rates move, assets and liabilities move together, protecting the funding position. The second part is the return-seeking portfolio. This is a smaller allocation, typically 20 to 40%, designed to generate excess return above the liability cost. Equities, private equity, infrastructure, real estate, hedge funds, and private credit all feature here. The return-seeking portfolio is what allows a pension fund to improve its funding position over time and reduce the contributions required from the sponsoring employer. Now let's talk about funding ratio, because this is the metric that drives almost every strategic decision a pension fund makes. The funding ratio is simply the ratio of assets to liabilities. A funding ratio of 100% means the fund has exactly enough assets to cover all its future obligations. A ratio above 100% means the fund is in surplus. Below 100% means it is in deficit. When the funding ratio is low, say 80 or 90%, the fund takes more risk. The return-seeking allocation is larger because the fund needs higher returns to close the deficit. When the funding ratio is high, say 110 or 120%, the fund de-risks. It shifts more assets into the liability matching portfolio, locking in the surplus and reducing the risk of falling back into deficit. This de-risking journey from high risk to low risk as funding improves is called a glide path. Many pension funds have predefined triggers. When the funding ratio reaches a certain level, the investment strategy automatically shifts. This removes emotion from the decision and ensures that a good funding position is protected, rather than gambled away. Let's look at some of the specific assets that pension funds use and why. Long-dated government bonds are the foundation of the liability matching portfolio. A 30-year government bond has a duration of approximately 18 to 20 years, close to the duration of long-dated pension liabilities. Buying long-dated bonds is the most direct way to match the interest rate sensitivity of the liabilities. Inflation-linked bonds, called TIPS in the US and index-linked gilts in the UK, are essential for pension funds with inflation-linked benefits. Many defined benefit pension funds promise benefits that increase with inflation each year. Inflation-linked bonds provide natural protection against that obligation. Interest rate swaps allow pension funds to add duration efficiently without deploying large amounts of cash. This frees up capital for the return-seeking portfolio while maintaining the duration match with liabilities. Equities provide long-term return potential, but at the cost of high volatility. Most pension funds have been reducing their equity allocations over the last decade as funding ratios have improved and regulations have become stricter. Infrastructure and real assets offer inflation protection, long-duration cash flows, and illiquidity premiums, making them well-suited for the liability matching book of well-funded pension funds. Private credit and private equity sit in the return-seeking portfolio, higher expected returns in exchange for illiquidity and complexity. One final point that most people outside the sector do not fully appreciate: pension funds do not manage portfolios the way a retail investor does. They do not ask, "What is the best investment right now?" They ask, "What investment best serves our liability profile, our funding ratio, and our regulatory constraints right now?" Return matters, but only in the context of the obligations the fund must meet. That liability-driven mindset is what defines institutional investing, and it is what makes pension fund investment management one of the most intellectually demanding disciplines in finance. If you want to understand how other types of institutional investors, insurance companies, sovereign wealth funds, endowments, approach their portfolios, subscribe to this channel. We publish weekly videos on institutional investing, fixed income, and portfolio management. And if you want a structured learning path, check the link in the description.